Rising interest rates in your portfolio. Investors have grown accustomed in recent years to historically low interest rates. Though there have been periods of upward movement, since 1981 the general long-term direction of rates has been downward. Starting in December 2008, the Federal Reserve Board lowered its target rate to between 0.25% and 0% to try to ensure that credit would be available to promote economic recovery. But what happens when the trend reverses? The decline in bond yields produced a bull market in bonds over the last 3 decades because bond prices move in the opposite direction from yields. That means that when rates begin to rise again, you should expect bond prices to begin to reverse direction. Here are some factors to consider in anticipation of a future with rising interest rates. Keep an eye on the maturity dates of your bonds. The prices of bonds with longer maturities will feel the most impact from rising interest rates, but individual bonds can be held to maturity to avoid loss of principal. Also, laddering a bond portfolio, staggering maturity dates so you can reinvest the proceeds as each bond matures, can help you adjust over time to rising rates. A bond mutual fund's duration can suggest the fund's sensitivity to rate changes. The longer the duration, the more vulnerable it may be. Review your bond portfolio to see whether a potential loss of value would offset the benefits of the higher income that longer-dated maturities generally offer. Bond prices don't necessarily rise and fall equally. Various bond types or maturities may react more strongly to interest rate changes or represent a better value than other categories. For example, during the fall 2008 financial crisis, the difference between corporate and U.S. Treasury bond yields rose because investors preferred the relative safety of U.S. debt to that of individual companies. If you own preferred stock shares, remember that because the dividend they pay is fixed, prices of preferred shares typically behave much like those of bonds, and also could be affected by rate changes. Rising interest rates often are an attempt to combat inflation. Unlike bonds, some assets have historically benefited from rising inflation. For example, commodities such as oil and wheat often contribute to inflation rates, which in the last 30 years have declined from 1981's 9% inflation to less than 2% last year. Rising rates also could bring better returns on savings accounts, certificates of deposit, and money market instruments. However, remember to include the impact of inflation when considering the return on such cash alternatives. Though no one can predict the timing of any changes in interest rates, now might be a good time to review whether your portfolio is positioned appropriately. Don't hesitate to ask questions and get expert help.